So in this video, I wanted to talk about the poor man's covered call and why I don't necessarily like it, or I don't necessarily see what the advantage is. So first of all, I'm going to explain what the poor man's covered call is. I'm also going to say, and let me just start off with showing what it requires to sell covered calls or poor man covered calls in Canada. So if I go to Questrade here and I go to accounts, so you'll see here with Questrade level 3 options, which requires 5,000 minimum balance, 5,000 Canadian equity. You could do long calendar calls or long diagonal calls. So it's basically a poor man's covered call is just the fancy term, but the real term is a long diagonal call. And note here, you cannot trade any level 3 option strategies in registered accounts. So that means you cannot do poor man covered calls in any registered accounts. TFSA, RSP, you can't do poor man's covered call. You'll need a margin account or a non-registered account to get level 3 options so you could do long diagonal calls. So if you're watching this video about poor man's covered calls, I assume you know what covered calls are in general. So in general, covered calls is when you buy 100 shares of a stock and you sell a call option against it. So if I go to options here and just look up any stock here, let's say Chewy, and then I get option choices, multi-leg options. If I do a covered call and I just click anywhere here, on the side you could see here that a covered call is buying 100 shares and selling a call option against it. So I'm paying 100 times the price of the stock, but I'm collecting $3.70 for one call option. So my net debit, so this is 84 is debit, but the 370 is a credit. So 84 minus 370, I only end up paying about anything in between 80.55 and 81.23. That'll be my net debit to enter the covered call trade. So I still have to put up a lot of capital. I have to put up $8,000 to do a covered call trade on Chewy. Let me just change the expiry date here just so that it makes more sense. If I take a May 21st expiry and I go at an 85 strike, so I buy 100 shares of Chewy at $84, I sell a call option, May 21st expiry, 85 strike for $8 or $7.90. So I pay about $77 to get into the trade. What's the consequence? So if the stock at expiry, so May 21st, if Chewy is trading anywhere above 85, I lose my shares at 85, or I have to sell my shares at 85, but I don't care because I entered the trade for 77. So 85 minus 77 is my profit. So I'm basically collecting premiums up front with a consequence of, or a trade-off of potential capital appreciation. If the stock goes to 100, 110, 120, I don't take advantage of that because I sold a call option which limits my upside potential. So that's the restriction with selling a call, but some people like it because you're collecting premium upfront. You don't have the mystery of waiting to see if the stock is going to go up or not. So if it's a flat market, or if the stock drops and you're selling a call, well, at least you collected premiums instead of collecting nothing. So remember what a call option is. It's important to know what a call option is. A call option is the right, but not the obligation, to buy a particular stock at a strike price at a given date. So let's look at the definition here. Call options are financial contracts that give the option buyer the right, but not the obligation, to buy a stock at a specified price within a specified time period. So remember, that's for the buyer. What if we are the seller? So if we're the seller, that means we're just on the other end. That means whatever the buyer decides, we're exposed to that. So the buyer has the right to buy our shares at a particular price, which is the strike price that he bought the call at, within a specific time period. So before the expiry date or after expiry. So if the option buyer that we sold the call to decides to exercise his call option and decides to buy the shares, that means we have to sell the shares. And since we own shares, we're going to have to sell the shares at the strike price that we sold the call at. So we would sell shares at 85. But that's okay because we collected $7.90 for that. So that's just the general overview of a covered call. Now, the problem with the covered call is that it takes a lot of capital because you have to buy 100 shares. Why do you have to buy 100 shares? Because one option contract represents 100 shares. So to be able to cover for that call option that you're selling, you need 100 shares against it. So because it's 100 shares, it ends up being a lot of capital. If you're buying an $80 stock, that's $8,000 in one stock. So what the poor man covered call is basically replacing 100 shares with a long call option. Because basically in a covered call trade, we have 100 shares to protect ourselves in case we have to sell shares. So we sold the 85 call and there's a risk that we have to sell shares to someone who bought the 85 call. So instead of protecting ourselves with 100 shares, we can protect ourselves with one call, which is basically the opposite of a short call or selling a call. But of course, we're not going to choose the same expiry. When we're not going to sell the 85 call and buy the 85 call, otherwise it cancels itself out. The general way of setting up a poor man's covered call is you're going to buy a long call. So it's called a diagonal call, as I mentioned earlier. And let's say we take the same expiry in terms of selling the call. So we're going to sell the May 21st call for an 85 strike, for example. But this time we're going to replace 100 shares with a long call, but it's usually a leap. So an expiry that's very far. So let's say we take the January 2022 or even January 2023. So we're going to take the long expiry, a further date expiry. And not only that, but we're going to take an in the money call. So the stock's trading at 84, a deep in the money call would be, or a deep in the money strike would be, let's say 40. And usually you want to replace shares. Shares have a 1 delta or a 100 delta. So you want to get as close as possible to that. So you're not going to get an exact 100 delta, but you're going to probably pick an 80 delta on the long call. So if I click on show Greeks over here, you see that 40 call that I bought has a 90 delta, while this call option that I'm selling has a 53 delta. So I'm basically replicating 100 shares by buying a leap call, which is right over here. Buy 1 January 2023 40 call. What that does is instead of paying $80 or $77 for the whole covered call trade, I'm only paying $45 for the trade, so $4,500. So it's less capital to get into the trade. Now what happens if the buyer of the call option that we sold, the 85 call, the buyer decides to exercise? So we have to provide the buyer of the call option, we have to give him shares, but we don't have shares. But what we do have is a long call, which we can then exercise for shares. So that's how this long call protects us in case the short call gets exercised. Now in practice, you don't necessarily have to exercise your long call for protection. You can usually get out of the whole trade by closing this entire trade for a profit. So for example, you got into the trade for, let's say, $43. If the stock goes up, you can probably close the trade for $45 or $44 and make a $1 profit. Times 100, that's $100. Or you can roll your call option, so you can keep collecting premiums as much as you can from this call option. So change the expiry, keep the same strike, just keep selling more calls against your long call protection. I'm going to show you what it looks like on a P&L graph. So what's your profit and loss as the stock moves. But before doing that, I just want to say why I don't necessarily like this poor man's covered call trade. So in Canada, we need a margin account or a non-registered account to trade the poor man's covered call. So you're most likely going to be in a margin account when you're trading this. So let's look at the capital required to place this trade. So if I place this trade, you could see that the trade value is 4,500. So that basically means the cash that's coming out of my account is 4,500. The change in buying power is 15,000. The change in maintenance excess is 4,500. So the change in buying power is 15,000. Why? Because I'm in a margin account and I'm using cash, it basically assumes that I'm losing $15,000 of buying power, because because I'm in a margin account, I can actually borrow against my cash, my stocks. And the typical borrowing rate is at 30%. So if I want to buy $3,000 worth of Facebook, for example, I have to put up $1,000 of my own cash. So by putting up $4,500 in this trade, I miss out on, it's taking $15,000 of buying power from me. So remember these numbers. So 4,500 cash, 15,000 buying power, and 4,500 maintenance excess. If I go to my balance, just to explain here, so my cash line would drop by 4,500. My maintenance excess line would drop by 4,500. And my total buying power would drop by 15,000. Now, if we go back to the covered call trade on Chewy, which is buying 100 shares, you can see that I'm gonna have to spend about $7,700. Now look at this. Change in maintenance excess, 1,800. Change in buying power, 6,000. Trade value, 7,600. So the cash that's coming out of my account is higher. So if I compare covered call to poor man's covered call or a long diagonal, the covered call uses more cash, yes. But it actually uses less maintenance excess and less buying power. Because I'm in a margin account, if I plan on using margin, then the poor man's covered call is not that capital efficient. The covered call is more capital efficient. Why? Because I'm buying shares instead of buying a call. When you buy shares, you can borrow against it at 30%. But when you buy a call option, you cannot borrow against it. You can only use cash to pay for a call option. But with shares, you can borrow against it by just putting up 30% in capital. 7,600 of cash is coming out of your account. You have more buying power remaining to do other things. So remember, we had 15,000 buying power for the poor man's covered call. And with this covered call, with shares, we have 6,000 buying power that's only used. We had about 4,500 of maintenance excess used for the poor man's covered call. With the regular covered call, we have 1,800 of maintenance excess used. So depending on how you define capital efficiency, one might be better than the other. In my opinion, straight up covered calls with shares is better in terms of capital efficiency because you have to do it in a margin account anyways in Canada. So you're using less maintenance excess to do the covered call trade. Now, if you're only using your cash to trade or to invest, you never plan on using margin anyways. So in that case, a poor man covered calls would be less capital efficient because you're using less cash to place the trade. But if you plan on using margin, then the regular covered call uses less maintenance excess. So the covered call is more capital efficient. And the other reason I prefer covered calls over poor man's covered call is you own shares when you do covered calls. So there's no expiry on shares. You can hold on to them forever. But when you buy a call, it has an expiry. So when I bought the January 2023 long call at a 40 strike, if the stock doesn't go my way, I could lose what I potentially paid for that long call. If Chewy drops below 40 at expiry, I would lose everything I paid. So going back to the poor man's covered call example, the diagonal call, January 20, 2023 for the 40 call, I still have to pay about $50 to buy this long call. So what's my break even if I'm paying $50? My strike is 40 and I paid $50, so my break even is 40 plus 50. My break even is 90. So that means by January 20, 2023, Chewy needs to be above 90 for me to not lose anything on this trade. Yes, I am selling calls, so I'm collecting money, so I'm bringing down my cost basis. So yes, I paid 50, but I keep selling calls. I collected $7, so now it's like I only paid 43, and then the next time I'll sell another call. So I keep bringing down my cost basis by selling calls. So it's great if the stock is flat or goes up a little bit. What if the stock drops hard in the next 2 years? Who knows where the market goes? What if the stock drops hard? Your 40 call is going to decay, maybe not as fast, but it's going to decay. It's going to lose value. Yes, you profited from the first covered call, from the first call that you sold. What will be your next call? Which strike will you sell next time? Let's say Chewy drops to 60 in 2 weeks or in 1 month. Now let's look at the P&L chart just to look at different scenarios. What would happen if Chewy goes up, Chewy stays flat, or Chewy goes down in the scenario of the poor man's covered call? So to do that, I'm going to log into Questrade IQ Edge. I have to log out of the browser first. So the P&L calculator in IQ Edge is right over here. Just click on P&L calculator, look up the underlying, and then set up the trade. I'll just remove these two lines here, And you could add a strategy, diagonal call, and to make sure it's long, so you're buying the January 2023 40 call, which has a 90 delta, and you're selling the May 21st 85 call. Yeah, there you go. So there's our long diagonal call. So this here is the P&L chart for this type of trade. So the green line is at expiry. What, of course, expiry is in January 2023. So you could see that my break even, so I don't lose any money, I don't make any money, right over here, which is around 79. But anywhere below 79, I start losing a lot of money. At $60, I'd be losing around $1,600. So if you look at this side over here to look at the P&L, if I'm standing at $60 at expiry, you can see that I'd be losing about $1,600. If the stock is at 85 at expiry, I'd be making a profit of $500. And to the upside, there is no risk. I make a minimum profit of around $250. So the risk really is to the downside. If the stock drops, there's the risk. Now let's see what happens if the stock drops, let's say end of April. We're in the trade and the stock drops really quickly. So the stock is at 85 right now. Now let's say it drops to 70. So where's 70? 70 is right over here. So as you can see, I would lose $800 on this trade if I close the entire trade. Now what I could do instead of closing the trade is my call option would be profitable. The one that I sold would be profitable because I sold for $790. It's probably worth much less. I can keep the long call, but my long call has lost a lot of value. If I remove the short call from this P&L chart just to see what my long call is worth, if Chewy drops to 70, you can see that my long call would be worth about $1,500 less. On April 30th, if Chewy drops to 70, my long call will be worth $1,500 less than what I paid for it. So can you make up this $1,500 by selling another call option? Well, you won't be able to make it up by selling the 85 call. You might sell the 85 call, collect maybe $1 or $2, thinking that you'll sell it again and again and again and again until January 2023 comes. By then you will have collected enough credits to bring down your cost basis of the long call. Now I'm just giving my opinion. I mean, this could work, but I don't like being in that position not knowing if it would be possible to collect enough credit to pay for the long call. At least if I had shares, I can hold on to it. I just have to wait for the stock to come back up. Another argument would be if I can wait 2 years on a stock, then I can wait 2 years on this long call. And then another argument would be I could sell a call lower than 85. I could sell a lower strike. If you sell a lower strike, the problem with that is if the stock rallies, you might end up losing your shares lower than your break even because you chose a lower strike. So remember, we initially sold the 85 call. That means we would lose our shares at 85. We don't have shares, but we'd have to give away our shares. We would have to close the position if the stock goes above 85 by May 21st. We would be profitable in this case. But if the stock drops and we end up selling, let's say, a 70 call instead. So if I choose May 21st here, you could see that our break even at expiry of May 21st is 80. So if the stock drops below 80 at May 21st expiry, we cannot close our trade because we'll be confirming a loss. What we'll have to do is roll our call option of 80, our initial call option that we sold. We might not be able to sell the 85 again. It might be too far, might not be enough premiums. And if you decide to bring your call lower and the stock rallies, you'll have to buy back the call that you sold for higher. So you'll have to buy the call that you sold for a loss, but you will not make up for that loss with the increase of the long call if you sell the long call. So for example, so this is just an estimate. The numbers could be different based on volatility, based on changing delta of the underlying options. But you can start off the trade. So the poor man's cover call, the long diagonal, you start off by paying $50, but you collected $7. So you have a net cost of $43. And then at expiry, the stock is actually trading at 75. So you still have a net cost of $43. You decide to sell the 75 call because at 85, you're not collecting as much premiums. You're selling the 75 call now. And let's say you're collecting the same thing as before because 85 was the at the money call. It gave you $7. We're assuming it's going to be the same volatility. So it could be less. It could be more. So you're selling the at the money call, which is in this case the 75 call. You're collecting another $7. So right now your net cost in this case is $36 on the trade. But now the stock flies from 75 to 85. But before it flew to 85, when it was trading at 75, your 40 call that you bought and you paid $50 for was worth about $42 because it has a 90 delta. So for every $1 drop of the stock, it drops about 90 cents. So if the stock dropped 10 points, then the call option will drop about $99. I wrote 42, but it's 41. It's not going to be exact, but something close to that. So if the stock flies back up to 85 and breaches your 75 call, obviously by $10, so now your 75 call is now worth $10. So you're gonna have to buy back your 75 call because it's in the money. You're gonna have to pay $10 to close it. So you now have a net cost of $46, and your 40 call is now worth about $49. So this is assuming delta is still 90. The stock went up to 85, so it went back up 10 points. So it goes back up 9 points. So the option goes up $9. But there is some time decay, but it's very little time decay because it's a deep in the money option. It already doesn't have that much extrinsic value. So let's say it's worth $49. So you could sell that long call option for $49. You have a net cost of $46. So you would make a profit of about $3. So in my terrible example, this is actually profitable. But as you could see, you could get caught by selling the wrong call and getting breached, and then having to pay more to close the in the money call and not knowing the value of your long call, if it's going to be enough to cover for the loss on the short call. Now this could happen with covered calls as well, regular covered calls with shares. But in my opinion, at least with shares, you can hold on to it forever. You're not subject to time decay on the long call, even though it's very little. So I've never done a poor man's covered call because I've always been unattracted by the maintenance excess that it's using. I find that I prefer to buy shares. I don't have that time limit, plus it's using less maintenance excess. But that's just me because I do end up using that extra buying power in my margin account. Now, if you think the poor man's covered call is way better, please leave in the comment section below. And if you have a plan in case the stock drops on you in 2 years, also mention it in the comment section below. I really would like to hear that. But this was why, in my opinion, I don't like the poor man's covered call. So if you have any questions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.